Well, I guess when you say performance, I think you're meaning the market's performance. Obviously, we had a very significant downturn, and I believe that the signs of recovery that we are seeing right now are maybe not sustainable. So I think we'll be hovering around a little bit up and down for quite a while still. But that's at the end always the market, right? So when I actually use the word performance, I actually rather think about whether the industry acts in a capital efficient manner and whether managerial competence and delivery has actually improved. And I actually don't think it has that much improved, because if you actually look over the last 20 years, there was another speaker earlier at this conference who kind of had this very nice statistic that the mining industry only returned 3.5% of capital on average for the last 20 years. Now, I would argue that's not a risk-appropriate rate of return. So I think we really have to differentiate here. What is the market doing? Because when the market's going up and prices are higher, it doesn't mean that the underlying companies are becoming better, right? It just means that investors get lucky because there's more cash flow coming through the system because of higher prices. So I'm actually not sure that the real performance of the industry has improved. What has improved, that in a few metals or minerals, you have the prices increasing, like in met coal, like in zinc, and therefore investors are making money. But it's still very much, if investors make money in mining, especially on the public markets, right, it's still primarily a function of the underlying commodity prices. When the commodity prices go up, the equities go up. When they go down, they go down, right? I take the view that you got to make money wherever you are in the cycle, even in a low price environment. And many, if not most companies, don't do that. So I'm not sure if the real performance of the industry has improved. All I'm saying is a bunch of people got lucky again over the last 1.5 years because some metal prices have gone up. It's definitely changed, Sam, and the reason why it's changed is because we are in a market right now. We call this fast track to cash flow strategy. We're in a market right now where we can actually take control of assets that are development ready. In some cases have already been in production, and the management teams who we back bring them back into production. So there's no reason for us or any other private equity firm for that matter to assume earlier stage risks, because there's a very kind of significant opportunity set in very advanced projects, and sometimes in producing mines, right? That's one reason. The other reason is that if you go in early stage, automatically that translates in a longer hold period, because success in earlier stage mining project, exploration success, de-risking success, you can only monetize that in an up market. But we are by definition not always in an up market, right? So when the market goes down, and a lot of funds had that problem, when you invested in early stage projects, you just happen to sit on your assets then for many, many years, hoping the market will recover. We don't want that. So therefore, we only do those types of deals where we can make money in whatever the market environment's doing. And that ultimately is a producing asset. If you can't sell that, you can pay yourself a dividend. And producing assets, if it's a decent asset, are usually always M&A exit liquid, so you can always sell it. So for that reason, we go in relatively late stage, 2 years or less away from production, ideally closer to production. That's what we do. What do we find most prospective? I mean, we are pretty boring. We just do what we've successfully done before, nothing new. So we deploy capital again in those countries where we've been successful before, in Chile, in Brazil, in Canada, in Australia, for example, in a small number of African jurisdictions. I don't take a directional outlook which metals are going to be more promising than others, because all the forecasts are usually wrong anyway. We once did an internal analysis by how much the consensus forecasts deviate from reality ultimately. And I don't know from top of my head what the precise number is, but for some metals or minerals the forecasting mistake was in excess of 40-50%. So you can't rely on the forward curve, you can't rely on the consensus, so therefore we don't take a directional view. So we take a lot of those metals or minerals that the world needs a lot, and those we are investing in. Yeah, as I've said before, we're very boring. So literally we just play for continuity. So we back the management teams we previously backed again. We just happen to have none in Asia, right? So we deploy capital with those teams with who've been successful before, and we just continue doing that. There's no other reason really. No, I shall say, sorry for interrupting you. I shall say that most Asian countries do not have the reputation to be the easiest of investment destinations in mining. Obviously, we are great believers in metallurgical coal because, as you just said, we back Pembroke Resources in the Olive Downs complex in Queensland. We believe there's a very strong outlook for metallurgical coal. You can't produce steel really in large quantities without it. It's a statistic that I like to tell people. So 1 megawatt of installed wind energy requires between 60 and 80 tons of metallurgical coal, because of the tower of the wind turbine doesn't grow on a tree, is actually made out of steel. 1 megawatt of installed solar energy requires between 600 and 800 tons of metallurgical coal, because the solar panels are made out of steel. They don't grow in trees. So therefore, when people kind of come to us and say, look, this metallurgical coal, it's really bad, I said, well, are you invested in renewable energy? Yes. Okay, well, then you are indirectly invested in metallurgical coal. You cannot have renewable energy without metallurgical coal. On thermal coal, we are not investing in thermal coal. There are several reasons for that. One is our investor base doesn't like it, and the investor base of most private equity firms doesn't like it. But the other reason is also we just don't believe in that market going forward, in its long-term dynamics. We do not doubt that thermal coal has a very prominent place in the global fuel mix, but we think ultimately its importance is going to diminish.